heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's world headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is a special edition of Bloomberg Technology.
Because, Ed, throughout the show, we'll cover all the market chaos that's spreading from Europe to the US and beyond. Elaine Stokes from Loomis Sales hits fixed income. John Rowe of Elgin covers the macro picture and how it affects your tech exposure.
Plus, how the SVB collapse and bank crisis contagion could lead to the unraveling of Fintech liquidity. We'll discuss with Joe Zhao of Millennia Capital.
And we'll get the outlook on risk sentiment broadly. We're going to dive into the state of venture capital investing as clouds loom over the industry. Sarah Kunst of Clio Capital, managing director there. All that and so much more coming up. Let's deep dive into these markets because it is ugly out there. We're looking actually at the tech sector managing in some way to outperform, but we're only off by 0.9%. But we've got to focus in on where the heart of the problem is stemming from today. It is Credit Suisse, is the spillover effect of a systemically important bank. For the entire financial sector, that means European stocks really taking the brunt of it, particularly the bank index were off by more than 6% on the day. The euro, as I last saw, the key red headline coming across the Bloomberg terminal was that it's at a 2-month low. We're actually seeing the biggest sell-off in the euro that we've got dating back to the heart of the COVID crisis, March 2020. We're off by 1.8%. Ed, so much to dig into when we're looking at some of the read across. Interestingly, of course, the bond sector is where we train our eye. And we look at the significant move day after day, 4 straight days of more than 25 basis point moves on a US 2-year.
Right.
This is extraordinary, the entire contagion effect that we see across the banking sector.
I think we're thinking about the policy-sensitive corners of the market. NASDAQ 100, the majority of names in the red, but there is broadly some outperformance. Mega cap tech lower, dragging down the NASDAQ 100. Interestingly, Microsoft up 1.2%. Could be a flight to safety, although we're 24 hours after GPT-4 was introduced by OpenAI. You wonder if that stock is giving a boost. We have to focus on the banks and go to First Republic. Really significant drop lower after a number of credit ratings agencies cut the stock or the rating to junk. We're down 16% currently on First Republic. There's a lot of read-through from what's happening here in the United States, concerns about liquidity and shoring up the banking sector, also playing out in Europe. So let's turn back to Credit Suisse. Shares record drop, hitting a record low. Credit default swaps or insurance against default also trading above financial crisis levels. Let's bring in Bloomberg's Marianne Haftermeyer from Zurich for more on this. What are the latest moves when it comes to Credit Suisse, and what do we know about the health of this bank?
So we've got about half an hour until the market closes, so we'll see where the stock ends up then. But it has been plummeting today, and that's off the back of some comments from one of their anchor investors, the Saudi National Bank, earlier today talking about their stake in the bank and their ability, their non-ability to increase it more than 10%. But in reality, what we're seeing is a broad reaction across the European banking sector with all stocks down, off the back of some uncertainty with what happened with Silicon Valley Bank in the U.S. and some uncertainty around how stable European banks are. And of course, with Credit Suisse, you always have to add a layer to that with the fact that it's going through a very difficult restructuring right now and has lost a lot of confidence of its investors and clients.
Marianne, great reporting. Of course, Yusuf El-Din bringing that exclusive which sparked the whole concern over Credit Suisse. Marianne Haftermeyer, we thank you very much indeed. Let's broaden it out. Let's bring in Bloomberg's Sonali Basak, who, well, maybe yesterday we thought maybe the past was worse behind us when it came to Silicon Valley Bank, and now we enter yet a further bait of contagion when it comes to European financial safety.
It certainly does. And the thing that's important here is this is not a bank far, far away. This is a globally systemic financial institution with big presence in the United States, with counterparties across the world and clients across the world. So seriously, this is a very serious situation to see a bank under this kind of stress, because any way you cut the pie here, you have the shares trading at record lows, you have the bonds really trading very low for, again, a globally systemic institution, and the credit default swaps also widening out to levels unseen before. So a lot of records being faced by Credit Suisse, and therefore causing concerns in the market about it. There are sources of mine that say that this feels worse than Silicon Valley Bank in a lot of ways. Remember, for a globally systemic financial institution, there are backstops here, but there's some really interesting color that's worth noting, Caroline, and it's this. My sources say for Silicon Valley Bank, for example, if things kind of moved quickly in the pursuit of a sale before the depositor flight, it would have been easier to get the job done. But, you know, you have to wonder about what that looks like for Credit Suisse. Yeah. At what point do you reach a point where things get so bad that they're so hard to turn around? Right now, they are still obviously fine when it comes to their own liquidity. So we have to keep an eye on what the depositors do at the end of the day, given their capital sources here look very strained.
And Ed, I mean, when the read across is for the tech community is one that the idea that everyone was sort of too concentrated a risk. What's the read across when it comes to Credit Suisse and indeed for our own technology community?
Well, we know that venture firms, large and small, and a number of tech companies are still trying to finalise their banking. The read-through from what's happened with SVB to Credit Suisse now is deposit outflow risk, right, Sonali? That is still where we're looking, whether it's Europe or First Republic here in the States.
You want to hear something crazy, too? People forget this. Credit Suisse was one of the biggest members of the market when it came to financing. So to the extent people were worried about Silicon Valley Bank and the exit for the market, Credit Suisse was one of the biggest underwriters of SPACs in a hot market. They were a banker to a lot of the world's wealthy technology firms. They helped disseminate those pre-IPO shares, that pre-IPO equity, to founders across the world, to billionaires across the world that were able to get in early on a lot of these trades. It has a huge ramification to financing markets with the exit of a bank like this.
And Ed, I mean, also, we just had the CEO of Credit Suisse on yesterday saying that they did well from some of the deposits coming from Silicon Valley Bank to their own lender.
Right, but what you need to realise in Credit Suisse, and we'll get to this later in the show, all of this started happening back in the fourth quarter or sooner when it came to client assets and liquidity concerns. It's just the last 5 days have been astonishing. Bloomberg, Sonali Basak, you are coming back later in the hour. I want to bring in John Rowe, though, head of multi-asset funds at Legal and General Investment Management, LGIM, multi-asset fund with $85 billion in AUM. John, let's start here. Are we seeing a de facto tightening in this market? Is that what the concern is?
Yeah, we're definitely seeing.
Cara, I think we lost John, so I'm going to jump in here and just say, you know... Oh, John, I think you're back. Please carry on.
Sorry, yeah. So, yeah, I think we are seeing a tightening, and it'll feed through for several quarters. So we're seeing not just in the American market, but we're going to see it in Europe as well. And that'll mean that there are less kind of US and European rate hikes because more of the tightening can be done through tighter financial conditions and lending standards.
The issue, the hand-wringing, is that the Federal Reserve is having to hike rates and it's going to break things. Ultimately, how bad would a Credit Suisse breakage be?
Yeah, I think on the inflation side, that's actually been starting to look a bit better. We've had improved participation in the US. So the US labour market data has looked quite good. And there's been some softening in some of the inflation data before today, which was clearly a miss on the upside. I think, though, that the Fed will be...
Oh, we're having some technical difficulties with John at the moment. We'll get back to him in a moment. I think one of the key issues for me, Ed, is when you're thinking about the broader impact across asset is the bond market move. We know that John has exposure not only to NASDAQ futures, but also within his multi-asset funds. He looks particularly at the bond market. When we're seeing yields move so much, yes, this is about contagion risk when it comes to banks, but it's also been in large part about some of the PPI reading that we got today, the macro data points we still get.
And it all goes back to the Fed. That's why the reset on expectations was so important. Yes, it's a really basic idea, higher rates discount present value of cash flows. But actually, I think we're really focused on the short end when it comes to policy-sensitive stocks. Sonali Basak, I think you're still with us out in New York. What are you watching right now broadly in the sectors you covered? Forget Credit Suisse as an isolated incident, but what are we hearing from the US banking sector in particular?
I'm glad you asked this because I asked, what are the pain trades right now? Is there anything that you could buy in this market? And I'm hearing things like gold, Ed. You know, this is how tough this market is, that even safe doesn't feel that safe right now. Credit trades, investment grade trades, are these under pressure in a market like this? Even some of the big regional banks here, remember, we faced that downgrade downgrade for First Republic. We've been talking about this a lot. First Republic was also a bank that many people moved money to in the wake of Silicon Valley Bank, but the pressure on deposits here is what caused that downgrade. So the bonds had been trading lower, the stock had been trading lower after those rebounds we saw yesterday. So again, what is safe is a huge question in this market. I think one other thing I'm very curious about is the pain that might be felt. They call it the carry trade. And that is, remember, at the end of last year, we saw all the tech community feel a lot of pain in the hedge fund world, but the macro traders had come roaring back because of the volatility in interest rates, in commodities, in asset classes around the macro world.
Yeah.
However, now it looks like some of those trades are unwinding. And by the way, they're levered trades, which means they're used often on borrowed funds. So we are expecting a little bit more pain among investors and a broader set of investors, even the ones that had won out last year. To what extent that pain could be is a huge question mark.
And Shonali, hindsight's a beautiful thing, but we've had some of the biggest names in finance weigh in. You've heard from Larry Fink today talking about some of the domino effects, the worries about financial crisis more broadly. You've heard, of course, from the likes of Bridgewater Associates founder as well, Ray Dalio, talking about how maybe indeed SVB was some sort of canary in a coal mine. Yeah. Interestingly, Cathie Wood weighing in on Twitter, of course, yesterday. Of course, she says now it is obviously glaringly clear that some sort of bank crisis was coming our way. But ultimately, did you feel that?
It was so hard to tell because people got so complacent with the market. If you look at how many banks had taken advances, for example, from the Federal Home Loan Banks, which is not, standard behavior to see in the billions as done in the last year or so, there was a lot of it. And it's really hard to calculate. You would have to go through the regulatory filings of each of those banks separately to really get a sense of how much was borrowed at the end of the day and which banks were really borrowing to that extent to make sure that they had liquidity on hand here in the case of dire moments. These are dire moments. Again, I think what's hard for me, and I got a little criticism for this idea here that this is not 2008. Well, because there have been so many micro crashes leading up to this moment, and there has already been federal intervention, remind you, in the United States. What that looks like in Europe as well, and how much heft global leaders have to kind of step up and stem some of these concerns. That creates a rock in the hard place when the market is still worried about the Fed and in the inflation and the trajectory of interest rates. So everywhere you look, there are kind of issues to go around.
Well, we heard, of course, from Cliff Asness, who was saying, if you look at the bond market, that's showing GFC 2008 worries, maybe the equity market, not so much. Shonali, we are so thankful for your expertise day in, day out. Coming up, Ed, of course, we're going to be drilling down into more on this story. Elaine Stokes, Executive VP Portfolio Manager over at Loomis Sales & Company. Of course, this is all about the bond market, the fixed income read across. I want to look at what the two-year yield has been doing, of course, seismic shifts in a US government bond. We've also seen downward pressure on the likes of European stocks in particular. The European stock 600 off by 2.7%. And Ed, we have got some rolling news. If you're lucky enough to have a Bloomberg terminal, you go to T-Live Go, don't you?
Yeah, this is where the power of Bloomberg kicks in. Just constant markets analysis across every asset class. TLIV Go on your Bloomberg terminal. This is Bloomberg. Welcome back to a special edition of Bloomberg Technology. I'm Ed Ludlow in San Francisco.
And I'm Caroline Hyde in New York. We are markets through and through. Just before the market opened, we had that knock, that repercussion of a debt cut coming from S&P over to the likes of First Republic Bank. We want to get into that with Kriti Gupta joining us for more on what that has implied for the equity market too.
Yeah, a lot of pain at Caroline and Ed, and you're seeing this across the board for regional banks. And I should mention, in the pre-market, all of these names were higher by 8 to 10%. And now you've completely seen the Credit Suisse story turn it around. First Republic is, of course, our poster child for some of the pain in the regional banks, just given how similar of a profile it has to the Signature Bank story. And that really puts it in the focus when it comes to where the regulatory concern might lie next. Nevertheless, you are seeing a move about 18% lower on that stock, really leading the charge lower. The one stock you want to keep an eye on that's in the green is Western Alliance. This really coming off of a stake, a 5.3% stake coming from Ken Griffin over at Citadel. It's the only reason that stock is in the green and not following the trend. But again, I want to go back to our poster child of First Republic, because take a look at just what it's done in the last year or so. The dramatic drop of down about 80%. A lot of that losses really just coming in the last week or so. Once again, really showing just how much it's fallen from grace, especially when it comes to their price to book ratios. Even with that cheapness, still not catching a bid for that reason. Now, to add a little bit of salt to the wound, you are starting to see that downgrade now cut to junk over at S&P. Had an A- rating now to a double B+, and is still on credit watch negative. The reasoning here is they're worried about outflows, kind of this mass bank run, First Republic getting hit next after some of the chaos you've seen in SVB and Signature. They're also pointing out that there's a little bit more dependency in terms of their structure on net interest income instead of their fee income from their wealth management business. That is something that sets First Republic apart from some of its peers, and perhaps why it's getting hurt just a little extra when it comes to the scrutiny from regulators and, of course, from these credit agencies.
Yeah, outflow risk at the core of that story. Numbers will continue to track this hour. Bloomberg's Kriti Gupta, thank you so much. Let's keep it going and bring in Elaine Stokes, Executive VP and Portfolio Manager at Loomis Sales and Company. And Elaine, I'll ask you the question we tried to pose earlier. Is this just broadly a de facto tightening that we're seeing play out in front of us?
Yeah, I mean, I think that's exactly what we're seeing. We are finally getting proof, right? The Fed is finally getting proof that they are affecting more than just the housing market. They are affecting the lending markets across the board. Credit Suisse, we still have to deal with over the next, couple of days to find out just how far that contagion goes. Yeah. But what has happened within the U.S. away from Credit Suisse had already proved that point, that lending has changed. People are not as willing to be in private equity, venture capital, and lend to, they don't need to. Yeah. Yields had hit a point where they don't need to.
So therefore, Elaine, what have you been doing when you've seen the enormous volatility, not just in corporate debt, but my goodness, in US Treasuries, when we have on one day a more than 25 basis point move that has then become a 4-day straight from the upside to the downside in terms of borrowing costs?
Yeah, it's funny. In times like this, we expect to be really, really active. And it's been a little bit disappointing. Within the Treasury market, we were running neutral in our funds. And now it hit a point where we went to an overdone place so quickly that I don't necessarily think that what the Treasury market is pricing into the market is reality. Do we really think that there are going to be 125 basis points of cuts by January? That seems a little overdone.
But Elaine, that's exactly what our technology viewer is trying to get to grips with. For our viewer, the context is, Loomis Sales has a storied history in bond management. You've got hundreds of billions in assets under management. And you're trying to read the tea leaves of ultimately what the Fed does in this scenario. Does the Federal Reserve focus more on financial issues, contagion, bank risk, or does it focus more on inflation and some of the concerns there that ultimately means they have to hike rates?
Yeah, I do think that the Fed probably hasn't made a decision, and the Fed is going to watch what happens over the next couple of days. And does Credit Suisse and what's happening there take us to an right? They know more than we do, but they don't know what the markets are going to do here. I think if they were to be making a decision today with what they know, economic numbers that don't lie, but are definitely distorted by weather, distorted by some other exogenous factors, and the amount of fear that's in the market right now, I think that they would hold off. But we could see something happen in the next couple of days that settles the markets down and allows them to do that 25 basis points. I mean, the market right now is saying it's a 50-50 chance. At least that's what the Treasury market is saying. It's a 50-50 chance, roughly, that the Fed is going to cut 25 basis points. I do think Elaine, something that's pretty... Oh, go ahead.
Well, Elaine, no, I want to tie this together. I want to understand why this is happening right now. Let's go to the Bloomberg terminal and look at Credit Suisse, CDS, credit default swaps, trading at financial crisis, above financial crisis levels to ensure against default. This was happening at Credit Suisse in the fourth quarter in terms of client asset outflows, liquidity metrics dropping. SVB happened, and it seems as if everyone suddenly realized again that bank liquidity is important. Why are we sort of happening? Why is this happening Wednesday, right now? What's the catalyst for you?
Well, clearly, when the largest shareholder comes out and says, there's no way I'll put another cent in, you fear that they know something you don't know, right? That I think is the fear that's going through the market. Everything we know is that, Credit Suisse is a bank that had a different type of regulation than SVB. It seems to me to be a very different situation, and it was really all about that lack of confidence. It was all about a lack of confidence for the banking system. And if that reverberates, we're going to see more Credit Suisse, more First Republics. Now, the credit markets don't seem to be saying deep, dark recession and it's happened right away.
Yeah. Very different signals coming from very different asset classes. And Elaine Stokes, you're across, of course, the corporate credit world and the government bond world. And we want to thank you so much for spending some time with us. Exec VP, Portfolio Manager over at Loomis Sales. We thank you. Stay well. So much more ahead across the contagion from Credit Suisse, the market repercussions, not only when it comes to PPI inflation data, but also more broadly across Europe and the US. This is Bloomberg.
And so there's an element of this, where this is less about immediate contagion. Again, remember in the great financial crisis, there was a lot of this that was about, cross counterparty credit risk. That's not what this is about.
Welcome back to this special markets edition of Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Let's take a quick look at the macro picture, the repercussions of, an investor that won't put an extra cent into Credit Suisse. The context to the SVB crisis and the market contagion means Europe, the stock 600 having its worst day in a year, but the euro having its worst day in 2 years. We're off by almost 2% overall. We're lowest levels in 2 months. The flight to quality, the Bloomberg dollar index soars up a percentage point. Sovereign bonds, they outperform, Ed.
Yeah, in the tech sector and equity markets, really interesting, like risk off, but no obvious move to safety. Goldman Sachs, profitless tech, only down 0.9%, outperforming really what we see in the equity space in the tech sector. The underperformance really in your semiconductors, the stocks down more than 3% at this point, Caroline.
Yeah, and I think the repercussions are far and wide. It's interesting that actually the NASDAQ, the technology sector, somewhat outperforms. The flight to the bond market, I think the volatility there is one that you have to keep an eye on. And this is a context in which this affects every risk taker out there. What does this mean for future deal flow? What does this mean for investing in technology more broadly? It's notable that some of the key tech stocks do outperform to a certain extent, and Bitcoin actually remarkable amid the dollar strength.
And tighter financial conditions, they don't hit mega caps, they hit small. We'll keep tracking. That's all next. This is Bloomberg.
Welcome back to a special markets edition of Bloomberg Technology. I'm Caroline Hyde in New York. It is 4:30 p.m. in London, and of course, we've got to keep a keen eye on the European ripple effects, the Credit Suisse concerns. It has been a remarkable day of trading in European assets. Ed, you got the latest.
Yeah, look, banks the main driver. The Euro Stoxx Banks Index down 8.5%. Biggest drop for the banks collectively since March of 2020 when the pandemic hit. But Credit Suisse, of course, not traded within that index. It is Swiss, but down 21%. Biggest drop on record. Stock trading at its lowest level on record. Also movement in currency markets. Euro dollar 105, but we're off by 2 cents or 2 percentage points almost. What a volatile week it's actually been in euro dollar if you think about it. And then we're debating on the show whether there's this flight to safety or not. But you look at the short end on the German 2-year Bund. We're off by 5 basis points, 2.38%. Banks, and more banks, Caroline.
What's remarkable is also the relative strength of technology, off by the least in terms of benchmarks. We're off only by 1.1% on the NASDAQ. But let's broaden it out to the movement in European assets, the read across to the US and global financial sector. I'm pleased to say Guy Johnson working late for us in London, Shanali Basak on overtime here in New York. Guy, in London, first and foremost, just the contagion concerns around Credit Suisse. It felt as though it was a Bloomberg interview that sparked this morning.
It was Youssef Gamal Al-Din's interview this morning, certainly sparking the latest crisis for Credit Suisse. But as somebody put it to me earlier, this has been a slow train wreck. Credit Suisse has been having problems for a really long time. And you've got to remember as well that this is a globally systemically important bank. The liquidity concerns that we've seen, for instance, in Silicon Valley aren't there. So this is a crisis of confidence that has been emerging here. But I think what it's doing, Caroline, is forcing European investors to rethink what is happening more broadly, looking at the ECB tomorrow, thinking about the possibility of whether or not the ECB is going to go by 50 basis points, talking about tightening of credit standards, an economic slowdown. I think the ripple effects you're seeing into other banks may be less to do with contagion and more to do with the fact that maybe there's just a repricing of potential earnings going on here. Take a look at what is happening in European bank bonds, and there's less of a ripple effect, which tells you maybe that story as well. So yes, the Credit Suisse story has been significant today, but it's having a wider effect, maybe a kind of wake-up call as to the ultimate impacts of this incredibly fast-paced rate cycle that we're currently seeing.
What I'm hearing, and I read the Bloomberg Top Live blog as well, is whether you're in Europe or you're in the United States, liquidity for banks is important. We should start talking about that again. Shanali, how is this playing out on Wall Street? How is this playing out in US financial markets?
Do you remember just a couple of days ago, Ed, we were very worried about the health of a lot of banks because they were facing depositor runs. And remember, that was even after this idea here. You saw a sell-off. I mean, after the idea that Sunday night you saw that FDIC rescue. When we're seeing these kinds of strains again, there is certainly a worry about the funding and liquidity behind these smaller banks in particular. I think Alan Blinder, when he spoke to Guy Johnson earlier today in Bloomberg's programming, he made this very interesting point that, of course, this is already, problematic when you see a globally systemic financial institution go through this kind of strain. But the big strain would really be, and this is what we're not seeing very, very importantly, is that same kind of strain go over to the other globally systemic financial institutions. What we've seen so far until now, and what we are still hearing very, very much so, is that though there's been a flight to safety, that those big banks have been taking in so many deposits that they often can't even tell us how many they have because things are moving so quickly here. Now, I think that leaves questions about everybody else.
Yeah, but the important thing, Shanali, here is that you are not seeing liquidity as a concern for Credit Suisse. This is confidence. It's interesting. Credit Suisse is basically, we understand from the Financial Times, gone to the Swiss National Bank and said, we need a vote of confidence. This is about shoring up confidence. It's about buying this bank time, maybe to execute its plans. The rules are in place for a reason, and we're not seeing the difference between Silicon Valley Bank and what's happening with Credit Suisse is that you're not seeing that liquidity pressure maybe there. This is a bank that is still able to function with the liquidity that it has. And maybe that is the big difference here. But what it does tell you is that there may be a bigger effect on financial conditions. And this is what the wider market reaction is all about. Banks are going to tighten lending standards. They are going to be potentially spooked by this, and potentially that leads to the lower earnings, which may be being priced in today.
And this is what systemically important means. And they might not have the wall of support coming on Twitter from big VCs, but they're certainly behind the scenes trying to get a wall of support from certain regulators. And I think, Shanali, what next, therefore, in the world of reporting, the world of disclosure, are we waiting for to push this story forward?
I think a few things to watch for, and Guy's point is very, very important, that this is a bank that has money and it has a lot of clients, and those clients, there are a lot of sticky clients, because remember, there are not a lot of wealth managers around the world that are this big. I think that is very important. They have loans tied to assets around the globe. That is all very, very important. But to Guy's point as well, these kinds of strains do tighten financial conditions very severely. And that is the commonality between both Credit Suisse and what's happening here in the United States. There's a worry about extending credit. There's a worry about where people keep their money. And what we were saying before, there is a rewriting of what is a safe asset.
And Ed, you tweeted earlier, we're all bank reporters now. But ultimately,
Right.
this does have ripple effects to the world of technology.
Yeah, why do we care about tighter financial conditions? It's not the mega cap tech that gets hit. Look at their balance sheet. But everyone keeps telling us this comes out of SVB. We will see failures in startups. They will have a working capital crunch. And so you have to look at the private markets as well and say, how is this playing out on Main Street or Silicon Valley out here in San Francisco? Bloomberg's Guy Johnson, Sonali Basak, team effort. Thank you very much. Now, coming up, we'll continue with the banking crisis and how the SVB collapse and current global lender concerns could unravel fintech liquidity and funding pressures. And let's take a look at some of these regional banks, how we're trading. First Republic has really been the focus after a number of agencies cut credit ratings. We're down 24%, but the KBW Bank Index also softer. Of course, it has diversity of names that trade within it. We'll continue to keep across those moves. This is Bloomberg.
Welcome back to a special markets edition of Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Now, how could the SVB collapse and current global lender concerns unravel fintech liquidity? Let's bring in Bloomberg Intelligence's Deeksha Gera. Yesterday, you IB'd me. I've got my research out. You scrambled. You're basically looking at the funding environment now as a result of what's happening. What's your conclusion?
So, Ed, the first part, I am kind of surprised people are talking about contagion in the banking sector and how undermined or how invisible the Valley's concerns are at the moment for what SVB has done, right? I was amazed until Sunday evening. I did not know whether deposit holders were protected. We were waiting and we were watching what it does. SVB leaves a huge hole in the Valley, 65,000 startups. Finally, on Sunday, we heard about deposits that they were taken care of. And then what about credit?
Right.
So I don't think people appreciate what a big gap this is and how few alternatives the Valley has to kind of replace it.
You're covering fintech now with us in San Francisco, but you actually spent a long time looking at the banks. And I'm trying to get the read through from what happened with SVB through to what's playing out at Credit Suisse today. What do you make of it all?
It hit a bit closer to home for me. I was at Lehman when the bank went under, and I am, again, amazed at how little we've learned over the years. We thought that by Sunday, if we come in and say all deposits are protected, we are good. This is not Lehman. This is not going to have any contagion impact. Did we really think, and were we really that short-sighted? At Lehman, we thought, okay, let's make an example out of this one bank, and then we'll see how this goes, right? With SVB, this is one bank. We're discussing moral hazard, like, should we be using taxpayers' money to bail this one bank out? When you have a fire in your house, Ed, what do? Do you think, well...
I'm hoping I don't have a fire in my house, but no, I get your point.
How do you think about it? Do you think, okay, let me put out that fire first? Or do you actually go and think, oh, if I put this fire out, the person who lit the fire will never realize what mistake they made?
Right.
That is the discussion we had on Sunday. And I was amazed at how little we learned with what happened with Lehman and how little we learned that in this environment, any confidence crisis, the way it can blow up, I'm at short of words, I'm lost of words.
It becomes then a lesson for regulators too, Deeksha. And at the moment, this is the difference. SVB, not systemically important, but was too big to ignore. Whereas many are now wondering whether Credit Suisse is too big to bail out in many ways. It's certainly too big to fail. I'm interested in the repercussions from your perspective, from a regulatory perspective, when it comes to banks, but also those fintechs too.
So very simple, Caroline. First things first, these companies, these startups, there's a reason why this bank grew to the scale that it grew, right? It's not like Citi was sitting there with open arms and banking all these startups, and while Silicon Valley was poaching them away. It's very hard for big banks to bank the startups. This is one bank that understood the Valley, that understood the VCs, that understood the companies they were banking and they were supporting for 40 years. Operationally, risk appetite-wise, there are very few companies who can actually come in and fill in that gap. Now, talking about the systemic impact of this, right? If I'm not sure whether my deposits are safe, people were thinking that Silicon Valley's deposits will probably move to FRB or other banks. But do you think that as a startup founder, I'm comfortable putting my money elsewhere when I'm not even sure whether I'm going to get that back from the first bank that we had? So obviously there's a confidence crisis, and I think it'll be a while before we can fix this problem.
Confidence crisis that we see reflected in equity markets, with the biggest fall on record for Credit Suisse in Europe. It continues to trade over here in the US on its ADRs, and Dick Shigeru is going to be looking all at some of the publicly traded fintechs and privately owned ones with Bloomberg Intelligence. We thank her so much, bringing in her history, her context of Lehman there as well. I'm pleased to say we can dig yet further into the world of private money allocation, but also a history of someone who worked at the Federal Reserve itself. Well, let's go to Joe Zhao, founder and partner over at Millennia Capital, a venture fund focused on tech and private markets. You've got exits including fintechs like Robinhood, Marqeta. You've got money in huge juggernauts in the private space like SpaceX. Joe, your perspective right now on the regulatory repercussions of what's happening with Credit Suisse in Europe and Switzerland, but also what happened with SVB here in the US.
Yeah, look, since the Fed began tightening financial conditions about a year ago, I think in the Valley, at least in the private markets, many companies have began to readjust their operating plans. And for those that haven't, I think what happened in the last week is sort of a wake-up call. So I think by now, almost, I would argue, most of the companies in the private markets are now preparing for a slowdown in the markets and the economy. So now, I think in the short term, many founders, the one I've seen in our portfolio, in our network, have been opening new accounts, getting new access to line of credit, extending cash runway, and cutting cost. But I think in the long term, it remains to be seen what the ramifications are. But I have a few theses. I think one is that there's definitely going to be new regulatory actions coming from the Fed, the Treasury, to further tighten bank operations.
Yeah.
I think for fintech liquidity, I would say this year will be a test of what companies are going to survive at this point in the business cycle. And in my view, the ones that will survive will come out fine. And I think at least in our conversation with founders, most founders are on top of what's going on.
Joe, you say that there was this sudden need to diversify where your money is kept. When I'm talking to founders, when I'm talking to VCs, they're saying the issue is it's not as easy for a founder of a company to walk into JP Morgan and say, hey, I used to bank with Silicon Valley Bank. I need to put some of my funds into you. They have too high thresholds. How difficult is it to diversify in terms of where you put your money, whether it's at Credit Suisse and looking outside of there, or whether it's Silicon Valley Bank?
It's a great point. So across our portfolio, we've run an analysis. The larger unicorns, the one that have $50 million or more in cash, they've been banking with JP Morgan, HSBC, and the like, and Citibank even before SVB's incident. The smaller companies, the pre-seed, the Series A, the Series Bs, they've been banking with SVB, which tend to have, and the like, which tend to have kind of a lower threshold for minimum assets. So the later stage companies, actually weren't as exposed to SVB versus the earlier stage companies. But a lot of the earlier stage companies, have been trying to open accounts. Now, to your point, it is not easy to open an account with JP Morgan, some of the larger banks, which have a higher sort of a threshold. And so as a result, you're seeing some of the earlier stage companies going to B of A, First Republic, and even Brex.
But Ed, you've been reporting day in, day out, not only the impact on the startups, but the venture funds themselves.
Well, as Joe knows, if you're a firm with sizable funds, you've got more than one bank account per fund. You've got an operating cash flow fund. You've got de-risk or side bank accounts for side initiatives and funds. And Joe, what we've been talking about all show long are tighter financial conditions. How does that impact venture firms and their ability to move?
Yeah, so we've seen this as early as a year ago, even a little longer than a year ago, where you have a few channels of the Fed's kind of transmission mechanism hitting the real economy in the last year or so. One is that LPs, limited partners, investors in VC and PE funds, they've been allocating way more into fixed income at the expense of equities, just because it's a higher guaranteed rate of return, assuming that there's low risk. And so the second thing is that I think the decrease in valuations and market prices have also hurt some of the kind of the return profiles. So I think the last thing is, this is sort of, most LPs like pension funds have like a budget for what goes into equity, fixed income, real estate, et cetera. So because venture and tech have been outperforming in the last 10 years, that they've gone over that budget. So even sans the recent market correction, they were pulling back on allocating to equity. So with what's happening last year, they've cut back. So LP capital in VC funds have slowed down, which is why you're seeing a slowing funding. Last week, some of the VC funds that had their funds tied up at Silicon Valley Bank, they would even have trouble funding startups because their own funds were tied up in SVB. So it's been a really interesting year for investors.
Joe Zhao, founder, partner, Millennia Capital, thank you so much for your insight and how this has played out over the last 5 days. A lot more coming up. We'll continue the conversation around venture and private markets. A lot happening also in the public sector and public markets as well. This is Bloomberg.
Welcome back to a special markets edition of Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. Let's get to Bloomberg's Katie Greifeld with the markets. Katie.
All of the action is centered in the bond market. You have the S&P 500 down about 0.5% or so, but then you look at the Treasury market, the haven asset of the world. I'm going to steal a phrase from John Farrow. It's been trading like a penny stock for the past week. You look at the 2-year Treasury yield, that is just an expectation on where the Fed is going to go. It's down 41 basis points today. It was up 27 basis points yesterday. What that tells you is that all of the attention is on next Wednesday. What is Jerome Powell going to do? And it feels like no one exactly knows.
All right, Bloomberg's Katie Greifeld across the numbers. Thank you. Let's keep the conversation going with Clio Capital Managing Director Sarah Kuntz, who joins me here in San Francisco. You were one of many that breathed a collective sigh of relief Sunday night, but you must be quite worried still about what's happening in the banking sector.
This is not good, right? You don't want to wake up after sort of, hey, SVB's a little bit back on track. People are getting money out. First Republic has stabilized, and then you wake up to this news out of Credit Suisse and hearing that, that they don't really have another place to go to get more capital. That's not good, and the market's reflecting that.
Well, that's been the conversation of the last hour, tighter financial conditions. How does that impact early stage companies in particular? Basically, has the funding dried up from whichever source?
It's going to be a hard quarter to pitch in. Getting net new capital out of VCs who don't already have an obligation, to the money they've put with you is going to be harder than ever. And it doesn't mean it's totally dried up and there will be tons of people starting great new companies. But this is going to be a much different fundraising environment than even a few months ago.
What's been remarkable amid dollar outperformance on the day is actually resilience of crypto, of Bitcoin. Sarah, you're in Gemini, you're in FalconX, your portfolio is looking at crypto. Is this still going to weather the storm?
Crypto is a hedge that doesn't always act like one, but I think in these moments when people are looking around for yield, looking around for, what's uncorrelated to these larger market moves, Bitcoin does get popular again. And I think that, there's also been a flight to Bitcoin, away from some of the stable coins after the Circle debacle last week.
And also what's so interesting is the resilience of some big cap names like Microsoft. Now, many wondering whether that's the ChatGPT-4 announcement yesterday, the focus on artificial intelligence. I know that you're in Forethought, for example, an AI company. Yeah. Do we have time to think about AI at the moment?
We do have time to think about AI, right? Alphabet, Google announced some really cool innovation, and they're barely down today, and same with Microsoft. I do think that these new technologies that have a ton of potential are going to be the bright spot for a little while moving forward.
We were talking at the start of this year about checks being written. There was momentum behind AI. Similar question, but does that continue despite the environment we're in?
I think that people are going to continue to write checks into companies that are doing well. And I think that AI is a space that is feeling like it's doing well. And people want bright spots. These VCs do have dry powder to deploy. And they're going to go after the things that feel like, the highest potential return bets.
Sarah, Clio Capital, have you thought about your banking relationships of late? Just to bring it full circle, I'm looking at a headline. Treasury Department here in the US is reviewing US banks' exposure to Credit Suisse, and the officials are in touch with European regulators as well, we understand.
I think that everybody, learned what a sweep account was and then jumped to them. We'd already been utilizing a lot of those things at Clio Capital. And certainly, like everybody, we're paying a little bit more attention to diversifying our banking relationships because it doesn't hurt. And in situations like the last couple of weeks, it can very much help.
Right. Clio Capital Managing Director Sarah Kuntz. Caroline, one of the many people that jumped in a cab and raced across town to join us for this special programme.
An extraordinary amount of information we managed to garner from her, from a private perspective, a public perspective, perhaps even some resilience in crypto overall. But at the moment, the resilience is in the safety of the US dollar and US treasuries today, Ed.
Yeah, and this is why you have the private market participants in, right? We see how it plays out in the public markets, but the real terms impact, it's on the founders, on the tech companies, and we're having all of those on this show.
Fantastic. Well, day 3 of our new time change, and what another extraordinary day for a special markets edition of Bloomberg Technology.
Don't forget, so much to recap. We have a podcast, and you can find it on the Bloomberg terminal, as well as Apple, Spotify, iHeart, wherever you get your podcasts. We'll continue to track tech and these markets. This is Bloomberg.